Hey everybody, Sean Carney here with Bolt Financial Group, shooting another educational video. Been talking to a lot of people lately that have been saying, I have an advisor or I like to do things on my own. Usually people say, I got a guy. Well, I'm here to kind of pull back the curtain on Wall Street. After working for a large brokerage firm, I know how these firms operate. Okay, so on this slide, you're going to see a list of all of the mutual funds that Fidelity has to offer. Over 1,000 mutual funds are available. Now, I'm not picking out Fidelity. All the companies do this. But these companies have research departments that they spend tens of millions of dollars on to come up with mutual funds. If they really knew which fund was going to perform the best, how many funds would they need? Certainly not 1,000. The reason they do this is because they know the data. And the data show that only about 20% of funds that are out there are actually going to outperform their benchmark. And unfortunately for you, they put your money in these funds after they've already performed well, which is no indication that they're going to perform well in the future. In fact, the data suggests the opposite, as can be seen in this slide. And so your investments are chasing the returns, and they're just selling you these funds as 4- and 5-star funds, or however they do it, to get your money into their funds, to make you think that they're doing a good job. But really all it is a sales tactic. It's not based on academic research. And in this slide, we can kind of prove that. The top 30 U.S. equity funds from 97 to 2006 outperformed the S&P 500. Those same funds, though, 10 years later, underperformed their benchmark. And so there's currently about 28,000 funds that are out there. During this 10-year period and this 10-year period, only about 2,300 and 4,500 of those 28,000 funds actually survived. So these companies have 1,000 funds because they know they're going to kill off about 80% of their funds. They know that 80% of their funds are not going to be of any use to you. And they're just going to put your money in whatever fund does well in the past, which has no indication that it's going to do well in the future. And so Dalbar comes out with a study every year that kind of shows how the average investor does compared to the S&P 500. Okay, so over this 30-year period, the S&P 500 did about 10%. The average investor got about 4%. Okay, and it's because of these reasons. People in their 401ks chase, they look at their statement, they pick whatever fund had the highest return over the last 10 or 15 years. Okay, mutual fund companies and your financial advisors out there are putting in funds that are 4- and 5-star, and they're chasing the same returns. So you're always kind of going around and chasing the returns. And the data are showing that you're actually underperforming the market by investing this way. So if you're ready to stop getting tricked by Wall Street, if you're ready to invest with integrity, invest the way academics teach it, the way Nobel laureates and people like Warren Buffett invest, click the link above. I'm teaching a webinar on May 22nd at 8 p.m. We'll dispel some more Wall Street myths so that you can line your pockets instead of the Wall Street bullies that are out there. I look forward to seeing you on May 22nd. If you have any questions about any of these topics, we'd love to help you with integrity at Bolt Financial Group.